Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today marks our 200th episode of Market Insights and Observations. Let's get to it and thank you for watching. I didn't have a chance to get balloons for our 200th episode, but if you followed along at home, and I know most of our clients have, we really appreciate the following, the sharing, liking, and subscribing. Again, I'm only doing this for you in an educational purpose, and more importantly, what we're paying attention to at Blanke Schein Wealth Management, what we have in our empirical evidence, our research, both technical and market related, that the headlines might not be essentially saying or reporting on a daily basis. So we're going to break it down to what we believe is the most important. The take-home point, what's important to us. Like as an example, if you watched last Tuesday, I discussed the markets were looking to close above on the S&P 500 from a technical level above 4,700 later this week. What happened yesterday? It actually closed at 4,701. And so our technical research, again, earlier this week discussed that. When we researched it, I had the opportunity to bring it up on our Tuesday market outlook and observations. And again, on Wednesday, we have the S&P in fashion, not always, but more often than not, our research that we have, that we're spending a lot of time on, again, navigating our clients' portfolios, working it into our investment committee thesis, and ultimately, again, how we navigate portfolios, it's right on the mark. So again, that's sort of the update there. Today, we're going to go through education, sort of 101. One, we got a jobs market. It's the lowest jobless claims number in 52 years. It's a very positive impact. In fact, that then says, well, we had a lot of the unemployment benefits expiring earlier this sort of third quarter. And the question was, are everyone that's at home, are they going to go look for the workforce, or are they going to continue to be looking for additional government assistance? Well, today is the empirical evidence is saying, no, we've got a hot economy, we've got a reopening economy, and that is real, and employers have help wanted signs all across the spectrum and all across the different sectors. That's very healthy. Then that puts the Federal Reserve, again, I spent a lot of time this last year talking about the Federal Reserve, and we're going to talk about the yield curve this episode, because it's really, really important as we close out the year. We're even seeing some yield curve jumping back and forth and what that actually means to our investments and how we position accordingly. And then finally, what to pay attention to, what to look for 2022. In short, I'll do another episode again later this year about our positioning for 2022. We believe that we have still a very strong economy going into it. Again, so you see the lockdowns around the world, call it Austria, Germany, even Australia. That then we're seeing the net capital inflows into the United States that will persist and that will continue. The other countries or European countries will be hurt as a result of that. We're going to see that capital. We're seeing it. We look at inflows on a capital basis, on a daily basis, to see where the global money is actually either going or where it's actually being sort of most favored. And essentially, like anything else, money actually follows and capital actually follows where it's most favorable. In the U.S. is, one, we're reopening. Two, we got a solid economy. Three, we've got sort of still pro-growth business strategies or policies out there, if you will. We're still in a Trump economy. Build Back Better by President Biden has yet to be passed. In fact, the conventional wisdom was this year they were going to have all three branches, or two branches of Congress, all three in Democratic control, so they would be a breeze to pass sort of increases in taxes. They would work on the estate planning. By the way, we have an estate planning update and a tax update next week. I've got a subject matter expert, so tune in next Wednesday on the 15th of December. We have more information to come about that, but we're talking about how we position ourselves accordingly when Build Back Better does get sort of implemented. And we believe it will in some form, 1.7 trillion or less. We don't know. The horse trading is happening in Washington. But the take-home point here is this year for 2021, corporations and individuals can have a sigh of relief as we close out this year, because I don't think tax law will be changed, and we're still under the Trump policies of 2017 when they changed the tax law. Next year that all changes potentially, but in the meantime, that's one of the reasons why the market is still and the economy is still very hot. Again, favorable yields. Let's go to the yield curve right now, and this is the yield curve. And there are the different dates. So I started with, in blue, starts with January 4th of 2021, so the very beginning of the year. we had 4th of July, just about around 4th of July is the orange line, and I'll discuss that in a minute. And then the red line right now talks about the yield curve present day. And Rob, what's the yield curve? Well, it's the U.S. Treasuries, and it talks about the short-term end, so from anything from the Fed funds rate, and that's what the interest rates are controlled by the Federal Reserve. That's why I spend a lot of time on the Federal Reserve, because they have the control over the interest rate policy. At least they like to, right? And interest rates can do their own thing, and that's what we watch in the market on a daily basis. Now, fixed income markets are huge, right? It deals with, yields deal with mortgages. If mortgage rates will go up, they deal with basically how money is priced. And it also has the ability to slow down or speed up by lowering interest rates. That speeds up the velocity of money. By raising interest rates, that slows down the velocity of money. That's a way of slowing down an economy. That's why the Federal Reserve wants to raise rates, and that's why they discussed about raising rates and taking away stimulus for 2022. And that's what we're well situating our clients' portfolios for. But now, keep in mind, the yield curve moves all the time. If you followed and tuned in, it's actually been the story of 2021 is the yield curve movement this year. I know it's not very exciting for people at home, but hopefully we learned something today, and that's the intent of market insights and outlooks and observations here. So let's go to the board. The blue line last year, at the very beginning of the year, again, we're in the middle of, very beginning of this year. It almost feels like last year, but January was the beginning of this year. In terms of our yield curve. And again, on the 2, 10, and the 30 years is what I've plotted for us. We had 11 basis points on the 2-year Treasury, and only 93 basis points on the 10-year at the start this calendar year. And then we had a 1.66 on the 30-year. Why that's relevant is because we've seen both by 4th of July and both by December right now, the yield curve has risen, okay? Yields are rising. Another reason why U.S. dollar is up, right, is because it's a strong dollar policy. Currency and money is coming in from other currencies and supporting the U.S. dollar, but also favorable. We're raising our rates from the beginning of this year. The yield curve right now in the 30-year is 1.87. At 4th of July, it was 205. So we had a little bit more favorable sort of yield curve, stronger 30-year back then, but right now we've come down a little bit, so it's called a flattening of the yield curve. And the 10 years is what we spent all our time on. Again, at the beginning of the year, 93 basis points for the 10-year. Right now in 4th of July, it was 1.44, and now we're at 154 on the 10-year. So what you can see right now is a flattening of the yield curve. So when the 30-year comes down and the 10-year gets closer together, right? It's a lot closer, the 154 right now and the 187 versus the 144 and the 205, which was 4th of July. That's called a steepening curve. This is a flattening curve. And that is an indication that, one, we got to make sure that the 30-year doesn't go below the 10-year, because that's recession indicator. That's why we pay attention to the yield curve. Will there be a forthcoming recession? And right now we're good, even though my chart kind of looks like it, so I apologize. I'll do better next time in my crayon drawing. But right now we do see a flattening of the yield curve. So what we could see is the yield curve again rise once more when interest rates rise for next year. Again, we're going to attract more money into the United States as a result, because Germany, keep in mind, they have negative interest rates. Can you imagine that? So as our interest rates rise, we have a lot of sectors that we will position for. Financials will do well. We like healthcare and a few other sectors for 2022. Again, on an individual basis, contact us at Blanke Schein Wealth Management, but we're for your portfolio, because we're positioning accordingly. But we can navigate either which way. When interest rates fall, obviously tech does well, but when interest rates rise, there's other sectors of the economy and that are more favorable, and the earnings actually increase. So that's how we sort of play it, but we spend time paying attention to the yield curve and making certain that the long end of the yield curve, as referenced by the 30-year, does not go below the 10-year, because then that would indicate a recession. More often than not 100%, but actually if you look at history, it's about a 95% indication. So we look at all of that and we derive our portfolio asset allocation and navigating on a short and long-term basis for our clients. So that's sort of the education sort of update here of why we pay attention to the yield curve, because it matters. It matters to you, it matters to us, and it matters to our portfolios more importantly. So thank you for joining us on our 200th episode. We really are just blessed to have our clients just follow along and be so supportive in every which way. Again, like, subscribe, and share this with friends and family over the holidays. I know it's holiday season, so if you're spending time with me right now, I appreciate it. If you're going out there and having holiday parties or Christmas parties, be safe, and we will see you again next time. Thanks for watching.